Bob Morrow from emailhomes.ca, talking to the first-time home buyer again. Talking about taxes. We've talked about the land transfer tax before, and if you haven't seen that video, then please go look that one up, the land transfer tax. The tax I want to talk to you about today is a tax on your insured mortgage. And this is something that a lot of people don't even bring up until it's too late. For example, if you buy a house that's $270,000 and you're only going to put 5% down, the bank will tell you that you need to insure that mortgage because you're high risk. So they will go to CMHC or some of the other ones, and they will add that to your mortgage. So if the fee, the insurance is $9,000 on a $275,000 house, they will put that on the end of the mortgage, and you go, thank heavens I don't have to come up with $9,000. But what they don't tell you is that that service of $9,000 is taxable. And the tax on a $9,000 insurance fee is about $1,200. And you have to have that on closing because your lawyer is going to ask for it. Now, a good lawyer will tell you this ahead of time, but a lot of first-time buyers don't go to the lawyer until a couple of weeks before closing because there's no real need to. And the banks will often not bring this up because either they don't think about it or they forget about it. So you need to know, and the best way to do that is once you've picked your house and you've done the offer and everything else and it goes through, ask your bank how much the insurance is going to cost. Then you take 13% of that, and that's what you have to have in your bank along with the closing costs, the land transfer tax, the lawyer's fees and all of that. Because if it's 2 weeks becoming closing and you need to come up with $1,200 that you didn't have, that might just stop you from buying the house.